Hello everyone, welcome to our weekly market analysis. My name is Carl Capeleva. I'm the market analyst over here at ThinkMarkets Australia, and it is a pleasure to be with you as we delve into all the key markets and moves from last week and have a look to the week ahead. Let's kick off with the crypto markets. Not a great week. You can see red across the board, all apart from Tron actually, which managed a 1% gain. Avalanche the worst there, 24% to the downside. But most of these were green last week. In fact, Avalanche was up 40% the week before, but 40% off a very low base. You can see the losses building there in the monthly column and also, unfortunately, in the yearly column. The fear and greed gauge now to 11, down from 14 last week. Having a look at the chart of Bitcoin, we can see that the 17,585 continues to hold for now, but as we are bumping along the bottom and with plenty of black candles in the system, I would suggest the evidence is skewed towards the downside. 13,870 would be the next target. That is the 2019 bear market high. Maybe that's where this move completes. Watch for some candles down there with some long lower shadows, maybe some white candles with a huge volume spike. That would indicate the final capitulation. Failing that, it could just be another step down, another bounce along the bottom. Couldn't get excited until we broke above that light pink zone. You can just see how well this short-term downtrend ribbon has terminated any rally. So we need to get above that, and preferably I would suggest 25,366 before we even contemplated this short-term downtrend is coming to an end. Ethereum looks much the same. Again, you can see the power of that light pink ribbon pushing prices down. 1281 is the key level. Hey, look, it's an important level to get past to the upside, but really the key level, that's the word I need for 1700, and to the downside 831. Really the only thing holding us up till we get into the sixes. Off the top of my head, there was a level down there, and then the fours, so precariously placed on Ethereum. Bringing it back to equities now, we can see that around the region, Japan fell 2%, otherwise rest of Asia generally higher. Not the case in the US, falls across the major indices there, in particular NASDAQ down 4%. I would say though that most of those falls came early in the week, and actually there was a little bit of a bright spark on Friday. We'll talk about that in a second, but you can see the volatility index still on the way down, so that's somewhat encouraging. Europe down also. The bright spark I'm referring to is this candle here on Friday for the S&P 500, the US benchmark. Coming down actually just after the open, but then closing up towards those highs, taking out the previous bar high, and with the higher low as well. That creates a trough here at 37.38, which is higher than 36.36. Higher troughs indicates building demand in the system. Now, if we can take out 39.46, we're going to move into this higher peaks and higher troughs phase, which is the first step towards moving back into a bull market. This idea of buy the dip, increasing demand, higher troughs, and decreasing supply stepping back with those high peaks. And it would actually take us above, if we do that, our short-term downtrend ribbon, which again has just been amazing at determining where these fledgling rallies terminate. Of course, we need to get above the long-term downtrend ribbon to turn this bear market around. But otherwise, looking at volume, volatility, candles, price action, where there's a warm chance here. Maybe we've seen the low for now. Having a look at the NASDAQ, slightly more risk on market than the S&P 500, of course, so didn't do as well, didn't quite move into that higher troughs pattern. 10,565 still the key level to the downside in terms of demand. To the upside, we need to break through 11,678. Preferably this week. It needs to happen quickly to get this idea of fear of missing out building among investors. And that would actually take us above the short-term downtrend zone. That's another positive. Maybe let's say 12,320 before we say that the short-term downtrend is unequivocally broken. If we break 10,565, then 9,838 would be the next logical downside support point. Having a look at metals now, they were broadly down last week. A couple of them bounced back. You can see tin up a little, steel up a little, aluminium up a little, but otherwise it was a continued trend to the downside. Copper down another 3.4 to 4.2%, depending where you were geographically. Zinc down 8.8%. Iron ore a little bit split. It was up in Shanghai in the yuan-based price, but down in the US dollar-based price out of Singapore, and then also on the COMEX exchange in America. Otherwise, we can see gold down a little, but the other precious metals a little bit mixed. Iron ore on screen, definitely a downtrend here. Definitely the light pink trend ribbon continuing to push prices down. 106 now the key demand point to the downside. Failing that, 84.60 is possible. We need to get above 125 at the very least, but I'd suggest probably above 140 to break this downtrend. Well-established downtrend also in copper. This is LME copper now. Look, continues to crack. Is probably the best word for it. 77.41 is the key point to the downside. And this is just such a great picture of how trends change. You know, it's all dark green, light green on this side. We break through that long-term uptrend. We come back, we test it, we fail there, we break through that sort of key trough that preceded the retest, and through there you are very much in now a long-term downtrend. The nickel price looking much the same. In fact, now below its pre-Russian invasion levels. That is disturbing. Again, a downtrend, long-term downtrend there. Gold is also in a long-term downtrend, but a far more subdued 117.87 holding. Interestingly, we'll get to gold stocks in Australia in a second, and they got belted this week, so it wasn't to do with the gold price. Looking at the energy complex, look, West Texas up a little, but Brent and natural gas down. Natural gas down now about between 35 and 40% from its high. So you would say that bull phase is over. Looking at crude oil, West Texas on screen, still holding the long-term trend, but I do think with 123.7 below 130.5 and these couple little peaks down here, I do think we do have supply building to the downside. A break of 101.50 probably will confirm that break, and then we'll see how we go at the long-term uptrend zone. Generally, currencies weaker against the US dollar. The Australian dollar now looks pretty much ensconced beneath that 70-cent level and probably heading towards the mid-60s, and a big drop in bond yields. I mean, that is 1/4 basis point cut by the market. You heard me right, 1/4 basis point cut by the market, as central banks, of course, are still ratcheting up rates. And that is because these markets anticipate what central banks are going to do. So if we look back around the start of 2022, when they started to rocket higher, we were watching this move, and we said this move is all about anticipating that terminal cash rate by, in this case, Australia's Reserve Bank. And look, we ended up getting up to 4.1%. For me, that's an overshoot because we're currently at 0.85%, probably going to 1.35% this week. But it's all about anticipation. So we're anticipating the increase in those cash rate levels. And now with rates coming down as much as they are, it's because we're worried that those huge increases in cash rates are going to break economies around the world. And therefore, central banks at some stage within the next sort of 12 to 18 months may well have to cut rates again. That's more evident here in the US. Rates, of course, going up in anticipation of the Fed's cash rate increases, but quite substantial falls now from that 3.5% high there, hovering now below 3%. So markets saying potentially trouble ahead for global economies, and evidence really in the data that came out last week. We see the Conference Board US Consumer Confidence Survey dropping 4.4 points on the main index down to 98.7. The 98.7 doesn't mean anything, but you know, it's kind of the trend is your friend on that one. Current conditions versus forward-looking expectations, that's a little bit more important. Now, current conditions only down 0.3 points because, let's face it, US consumers, workers, they're employed, their wages are pretty good at the moment. The current situation is not too bad, but looking down the track, the forward-looking expectations index down 7.3%, now at its lowest level since 2013, as consumers are becoming more and more pessimistic about business conditions, employment, and their income outlook. So it's not about what's happening now, it's about what's potentially going to happen down the track, and that's what the bond market's responding to. However, we've got this man over here, of course, Fed Chairman Jerome Powell, who, let's face it, started this whole bear market, because when he was reappointed on the 22nd of November 2021, go back and have a look, that was the highest point of the NASDAQ. It's absolute peak. It may not get back there for a very, very long time, because that's the day he switched from an ultra dove, that is keeping interest rates low, to an ultra hawk, that is he's going to fight inflation with everything he's got. He was speaking this week at a central bank forum in Europe, saying that there's no guarantee that the Fed will get inflation under control. That's his main target, without damaging the US economy. It's his aim, but it's gotten much harder. and the pathways have gotten narrower to this, quote unquote, soft landing. He said, though, perhaps a little bit delusionally, that the economy is well positioned. Well, it's well positioned now, and that's what the data from the conference board showed us. Well positioned now, consumers are okay now, but down the track, that's the problem. So maybe Fed Chairman here needs to be looking at some of that data and saying, well, the stuff he's already done has already had a significant impact on expectations down the track. Needs to be careful he doesn't go too far and drive the US economy off the cliff. Having a look at his preferred measure of inflation, that is the US core PCE price index. Now, PCE stands for personal consumption expenditures. We can see, just looking at the inflation gauge here, 0.3% for the third time in a row. If we annualize those 3 months, 12 times 0.3, you get to 3.6%, which is still well above the Fed's target of an average of 2%. So if we just kept sort of along at the rate we are, we're not going to get there, say, in the next 9 months, or certainly by around about March next year. Just putting into perspective how the Fed might behave. Wages, also a little bit disturbing. Now, they were up 0.5% for the month, in line with expectations, but a little bit hotter than the previous month. And again, doing this annualizing, because they've been at 0.5% for 3 prints in a row now. 12 times 0.5 gets you to 6%. So 6% wages growth year on year is actually pretty hot when you think about it. And if wages keep growing at that 6% a year, it's going to be very hard to get inflation further down than the 3.6% we're sort of tipping by around March next year. However, again, this idea that consumers are potentially pulling back, we saw expenditures at 0.2% of an increase. That was well below the 0.4% expected and way down from the 0.9% the previous month. And annualizing that, we're probably about 2.4% growth, which is on the low side because, of course, expenditures about 2/3 of GDP. We don't want to see GDP growing at 2.4%. We want to see it growing, in the 3s. So we've got a bit of a problem here. We've got some inflation, we've got some pretty hot wages, and yet we've got economic growth skewing towards the downside. Having a look at the Australian market now, we can see pretty mixed bag there in terms of performances. Definitely worst was the gold sector. Now, the reason for that 13% fall was not the gold price. We saw the gold price was pretty modestly skewed to the downside, but it was a production update from Evolution Mining. I've just taken a slide out of their presentation because whilst they had these, fairly transient issues of too much rain in certain areas and struggling to get workers due to, people being sick with COVID, this was the slide that really struck fear into resources investors, and that's rising costs. So we can see their labour costs around about 6% higher, not inconsistent with what we saw in the US there. They are still seeing those increases going to contract base, not yet flowing into their fixed pay workers, but labour costs at 50% of operating costs is significant. Then you look at their diesel costs, 130% higher than last year. That's about 5% of the operating costs. And power prices, they are higher as well. That's about 8% of their operating costs and, up 180% just from the start of this year alone. So investors started to extrapolate that across the broader gold sector, but also into the resources, which were down about 2% for the week. I'll let you press pause and look at how the rest of them went, but there's nothing too exciting in there, to be fair. What's more exciting is where the broader index is going, and if you looked at that, you would say it's probably going to go back down to 6407. However, I can see just on the open here, we are up about 1.5%, trading in sort of 6650-ish, 6640, depending on the print, and forming a higher trough here in line more with what happened on the S&P 500. So it's kind of predicting further gains ahead from the US this week. Of course, we do have their Independence Day holiday tonight, so we won't get any cues tonight. But look, it doesn't mean we're out of the woods. We need to get above this light pink zone, this short-term downtrend ribbon. We need to print above 67.64, preferably close above that level, and then really 69.30, a close above that would be required for me to feel that we have put a meaningful low in place. It's not a bear market low, we didn't go down enough of that, but a meaningful correction low in place. If we fail, so if we do have this little rally, US comes back, and it's back to doom and gloom over there, which is a real possibility, and we stay in this trend ribbon and push back down again, making another peak, then it starts to look a bit messy. It looks like 64.07 will be tested again, and we could break that head into 62.48. So at least giving you a pretty clear roadmap for what to look for in those key levels on the ASX 200. Going to broaden out a little bit, look at the ASX 300. This is our technical analysis market breadth now, and it's just telling us how many stocks are trading above their moving averages, their trends for various periods. And we've got periods from anywhere from 1 week, which is obviously 5 periods, 2 weeks, 1 month, 3 months, 6 months, out to a year. Ideally, what we like to see is the orange line, which is the current situation, up around this green band here, which is where the highs, the all-time highs, that's the market breadth at the all-time highs. You can see 70%. 7 out of 10 stocks are trading in uptrends across the board, and particularly in those long-term uptrends. That is the bull market. The bear market is down around this sort of 10% level, 10%. The worst it can get is that COVID low down there. That's you can see almost trailing there towards 0% of stocks in those long-term uptrends. We're still very much in that sort of bear market phase at the moment, anywhere out from a month, really, to be fair. So no strong indications here that we're seeing this broad-based rally coming in just yet. And we'll continue to watch this one very closely for evidence that potentially the trends are getting better even before maybe some of those key resistance levels have been taken out. Having a look at the trends across the various sectors now, on the benchmark we saw previously, we're still very much down and down, short-term and long-term. It's pretty much the same from there, unless you're in the energy sector, which is still long-term uptrend, holding that pretty well, as is the utilities, but they are both in short-term downtrends. Neutral on healthcare in the short term, neutral on staples, but those long-term trends still set to the downside. I think the message here is that there isn't a particular sector that if you had some cash and you're looking to allocate it, that you would gravitate towards at this stage. I still think it's very much caution as we go. Having a look at the valuations. Now, the most interesting thing for me in this entire presentation this morning is the fact that the 1 year forward PE, now it's still expectations. Now, expectations can change and the reality can be very different, but what the big brokers are expecting for earnings going forward is that we're trading about 12.7 times next year's earnings, and that is very, very low. So typically, markets will be around about 15, around about fair value. When markets are expensive, they're at 20. How about that? The peak since COVID, we got up to 20, which is officially expensive. And when we're at the lows, when there's a crash, we come down to around about 10, sometimes in the high single digits. We're at 12.7, so we're definitely getting towards that cheap level here. Wouldn't say bargain, but certainly cheap. Having looked at some of the sectors that are getting close to their pre-COVID averages. You can see discretionary sector, one of those sectors that has been absolutely pelted over the last sort of 9 months since that big pivot at the Fed, down to 19.8 versus 18.9, but well off its 30 post-COVID peak. We know energy's cheap, we know materials are cheap, they're cycling those higher earnings, so we'll just take those with a bit of a pinch of salt. Financials now below their pre-COVID average, as is utilities, and information technology, probably another one to note, down from its 77.4 eye-watering peak to 29.1, which is getting pretty close to that 26.3. So a few of these sectors now showing that the falls that have been built into the system are bringing them back to fairly attractive valuations. Looking at the data coming up for this week, without a doubt, locally, it'll be the Reserve Bank meeting we've got coming up, their cash rate determination. Most analysts expecting a 0.5%, so 50 basis point hike from the current 0.85 to 1.35%. There are a few out there predicting a bigger 0.75%. I don't think we'll get there. I don't think the evidence suggests we need to. So 1.35% is the tip for me. Looking abroad, we do have the bank holiday, as you can see there, the Independence Day holiday in the US, but we are going to get some data out for the Chinese economy. We've seen that Chinese market looking very strong over the last few weeks. So that could give us a bit of a bullish cue as well. Other than that, the big data is going to be the US employment data. That's coming out on Friday, and we will also have the FOMC meeting minutes coming out on Thursday. So just the commentary and the rhetoric around the Federal Reserve's last interest rate hike. Look, apart from that, I'm going to be back tomorrow for Ask the Experts. That's where you get to hang out with me for a full hour and ask me about the stocks in your portfolio. I'll give an in-depth technical and fundamental reader on each of those, and it is lots of fun and very educational. So make sure you head to the link and register, and I'll see you then. Apart from that, make sure you're trading with ThinkMarkets. We are the good guys in the Australian broking industry. We have all of the products you could possibly want to trade over here, as well as CFDs as well. So if you're looking to get some shorts into your portfolio or diversify out into some of those commodities and indices as well, head to the website and you could be trading in minutes. If you're watching me on YouTube or any of the other social media platforms, make sure you hit the subscribe button to stay notified of all of our new videos, and make sure you smash the like button to let us know you love what we're doing, so we'll continue to do it. Apart from that, it has been a pleasure chatting with you this morning. All the best for investing until we catch up again. Bye-bye for now.